I see that majority of the business owners are formed as sole proprietors or as partners. So majority of them doing this to save the cost on the professional fees. It costs much less. Some of them do it, and I hear this a lot too. Some open LLC or sole proprietorship to pay the salaries. There is like a significant cost to everything. Once they open as an LLC or a C corporation, basically majority of them file tax return as a sole proprietorship. So what does it mean for those of you that don't understand? So you as an individual, you file a tax return at the end of the year. And then if you, let's say, if you have a corporation, so that considered as a separate entity. So as a separate entity, you file the separate tax return. So in that case, you become you as an individual, you file one tax return, and as a corporation, you file a separate tax return. And then there's different types of corporation. There's a C Corp, there's an S Corp. You can, as a partnership, you can file a separate tax return as well. Obviously, by filing separate tax return, there is a significant additional cost to file, to pay for to the tax preparer for the preparation. And this is where typically business owners try to save the money. So now what happens is that when you're trying to save the money and then you file this one individual tax return, you file it on Schedule C. And then the way it starts looking is that we had one of the prospects coming to us as well. So they filed on a C corporation and they had 3 different businesses. So what the accountant did, since they have 3 different businesses, they filed 3 different Schedule Cs, and it's all on one individual tax return. And then they're showing all this money that they invested, they have a loss. This is all great, right? Which is normal. You opened up the business and now you have all the money that you invested into the company and you didn't make any profits, and then you're showing the loss. However, when this returns gets to be done and filed to the IRS, what IRS sees? That person that has no other income from any other sources. So that person has these 3 different Schedule Cs, all this money that they invested and they lost, and the tax return shows minus $60,000. So when IRS sees this type of returns, or let's say even if you don't have a minus, or maybe let's say you earned $60,000 and then maybe you spent $50,000 and then you only have $10,000 left as income, which you're thinking, okay, I don't have a loss, but now I have the income, which sounds like all right. But then when IRS gets this type of returns, for them it's a red flag. Number one, if you're showing loss and there's no other income, then how are you actually living? How are you paying your expenses? How do you pay rent? How do you eat? Like, like all these day-to-day expenses. Or if you're showing a very low income, then again, it triggers the audit as well. I don't think that you want the IRS audit, because once they will come in and then they're going to start looking into all the books and records and start identifying, okay, oh, you had income somewhere else, or maybe you didn't report it. You see, like this opens up this can of worms and all these unexpected questions that I don't think you want to have. So the very simple solution is to have a separate tax return for the company. So typically, again, it depends. There's no one size fits all. So it depends on what type of business activity, what you're doing. And this is where the strategic planning comes into the place. This is where we sit down and analyze, okay, do you need this company to be a C corporation? Or do you need to be an S corporation? Or maybe file it as a partnership, but as a separate entity. So like, let's say, for example, let's say if the business has a loss and you don't have any other income from any other sources, so you might actually want to keep and hold down to that loss, not even just for the IRS purposes because it triggers the red flag, but also because you want to hold down to that loss and keep it, let's say, for the next year or year after that, because after a year or 2, you're going to start having income in your business, and then you can offset that loss with the income. So that's another one of the strategies that we typically like to use. Like, for example, this works very well if you are opening up like a restaurant, or if you're opening a spa, or if there's something that a business where you need to invest lots of money, and obviously when the first year you're opening, you're investing the money, you have all these losses. But then as you start working and you start making this money, now you have to be paying taxes on that. But in order to avoid this, you can actually hold on to the losses, you can capture them and leave them up until the next years when you start making income. She actually had the same situation because for the past 2 years, she did file it separately as a corporation. But since she just started the business, was investing lots of money in the business, the company had losses. But then they did do it as a corporation, but they did it as a S corporation. So now the difference between S and C corporation is that with the C corporation, you can hold on to the losses and carry them on to the next years. With the C corporation, you take all the losses and all the profits right away. With the losses, if you don't have any other sources of income and you take this loss, it's gone. You don't get any benefits from it, and you definitely want to get a benefit. So, and then that's exactly what happened with that a client that reached out to us, because for the past 2 years she had losses and then she didn't needed them, she lost them, versus if she would have been structured different, she could have actually carried these losses towards the next year, because this year she is already on track of making like 200,000 in profits. So these are just some simple strategies of restructuring the company, knowing what's there. And obviously, like, I'm sharing all of that. That's a lot. That's why this is why we here. This is why our clients have us. And for those of you that looking for some guidance, knowing, okay, how do I actually structure my company in the right way? Do I need these losses, or I don't need this to show these losses right now? Do I need to be an S corp, or I need to be C corp? Is it sole proprietor or LLC? There's like so much. Like, how do I determine which one is the right structure for me?